Welcome to the daily update, where I'll go over the action in the market for Tuesday, July 29th, and we'll see how things look for Wednesday, July 30th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, had a down day. We've seen a few days now where the market opened higher and then set the intraday high and then drifted off of that, especially on Monday and Tuesday. That's what happened. And it's usually the signs of an exhausted market. We're still positive, and right now, even with the decline that we saw, it looks a little more drastic on the chart, but we were only down 0.3%. But it just, you'd think with the positive news, with things going on, that the market would do better. But we've been overextended, we've been overbought, the market has been over exuberant, just assuming that it's going to keep going up. We've got major economic reports coming out throughout the week. We had a pretty good dose of reports that came out in Tuesday's session. We'll see. We've got the Fed meeting on Wednesday. They're going to make an announcement. We have the employment report coming out on Friday. GDP, the first look for the second quarter, that's going to be coming out. So there's a lot to be concerned about here. So right at the open, we had a higher open. We got above R1 at 6402. The 6400 level is so far turning out to be formidable at this point. That's about where we've been topping out. And it's a high number. We set an intraday all-time high, but not a closing all-time high. And that was it. We declined back down below the unchanged level, and we fell below S1 at 6377. And prices just chopped above and below S1, not an awful lot of conviction. But then as we moved throughout the day, we declined down to S2 at 63.42. We did find support there, and then we were able to close up off of S2. We were down 0.3%. We were above average with volume. We're seeing that picking up, and that might continue because of all the heavy-duty things that are going to be digested by the market throughout the week with the economic reports and the Fed and so forth. And we're still positive on all time frames. All of this is still happening above the 20-period moving average. And as long as it can stay that way, the market will maintain more of a positive stance. If we drop below the 20-period, that's when we're going to probably shift to a more negative stance overall. And there's the trade deals that are coming through. We've got August 1st coming up. That's where the deadline was set. There's also another deadline for Russia to end the war in Ukraine. And, okay, what's going to happen if they don't? What's going to happen if there's no negotiating that's happening there? Okay, so some comments. The S&P, NASDAQ, and NASDAQ 100. We started off strong. They set new intraday all-time highs, but not closing all-time highs. Oil has gone up. There were comments that President Trump said that Russia will face secondary sanctions if it does not stop the war in Ukraine by August 8th. He said 10 days. Well, you count the calendar there, that works out to about August 8th. And he's trying to get Putin to the table. He's trying to say, hey, let's talk about this. But then it's like something seems to happen, and then there's this big attack on Ukraine. And it's really hard to negotiate something when it seems like you're being told what you want to hear, but then the reality is that things are still pretty intense. All right, earnings, again, continue to be taken pretty much as positive with optimistic outlooks there. Growth didn't have a good day on Tuesday, and where value actually picked up a little bit. So a little bit more of a defensive stance with the market that way. And the Stochc RSI has now fallen off the list of extreme positive readings, but we still have the Williams percent R, even though it declined. The CCI charts are still on there, the stochastics. The slope oscillator, still seeing some pretty flat momentum oscillators overall. And even though we came down, we're still extreme with the RSI short term based on 9 periods. Intermediate term, the Arun is now on the list. That's a new addition that tries to measure the difference between buyers and sellers. CMB composite is still extreme. We're still in the +3 channel. We're right on the border, but we're into that +3 channel with our standard deviations chart. Still looking extreme with our momentum oscillators, but some of them have actually turned negative because they're dropping below their moving average. The Sean trend meter, it's not as extreme as it was before, but it's still in that lighter green area, showing that we're extreme. And the bullish percent index, it's more, this should be for the Nasdaq 100. We saw a bit of a decline. We're back from being extreme with the S&P bullish percent index. We're still far away from the 50-period moving average. You notice that's not on the short-term list. We're coming down a little bit, getting closer to that 20-period moving average, but we're still far away from the 50. And then the intermediate term RSI is still extreme, even though it's rolling over a bit. And we're still far away from the 150-period simple moving average. So we're still dealing with an overbought condition on a lot of different time frames. And no change here to the overall scenario. We'll see if Wednesday changes this. The Fed will make their initial announcement. There'll be the gyration from the market. They're not expected to do anything as far as rate cuts are concerned. And then they'll put out that statement. The market will react to that. And then after that will be the press conference, and there may be some reaction to that. So far, the Fed just kind of comes out and says, well, we don't know what these tariffs are going to do. We're going to have to wait and see. And of course, you've got the battle between President Trump and Jerome Powell, because Trump thinks that the interest rates should be cut. There's a lot of U.S. debt that needs to be refinanced, and it would save U.S. taxpayers a lot of money if interest rates were lower to refinance that debt. But then you have to look at it from an economic perspective at the same time. It's like, does it need to have the rates cut? Or is this just something that the market wants that will help stock prices go up? Is there actually some logic behind it that makes sense for everybody? And then the dollar was up. We are seeing a bit of a bounce there. We're still above the 50-day moving average. Interest rates really fell, though, and this didn't really seem to help stocks all that much. We were getting up close to that 4.5% level with the 10-year yield. We were at 4.42%. But instead of going up, we actually came down to 4.33%, which is, for one day, that's a pretty significant drop. And we're still positive with sentiment, but now the context is turning a little bit more negative. We were actually above 75 for a while, then we got down to 74, now we fell down to 69. So it's dropping, but it's still extreme, or it had been extreme. And so now is when we start to watch this a little more closely. We pick up the context of this actually going down, and then we tend to go with that. So if this 69 number continues to drop from there, that might also show that the market is going down as well. We're still positive with the trend, though, and we're seeing some rolling over a little bit with our ADX charts. I'll go through those. Because we have the down day, the bias is negative. I'm still keeping the momentum the last 2, 3, 4, 5 days taken together as positive, because right now this just looks like a bit of a pullback. Okay, we had kind of a big list here, and from this point forward throughout the rest of the week, we're going to continue to get a lot of data. Consumer confidence came in at 97.2. That was higher than the 95.5 they had expected. The last time we had the report, it was 95.2. So the headline number is showing some improvement. But if you go back a year ago, we were at 101.9. So from the recent reading, better. Longer term, still not as confident about things. And then they actually break it out a little bit here, and I'll have the chart to show you too how people are feeling right now. Last time they were at 133. Now they fell to 131.5. Expectations, that's looking out into the future. It went to 74.4. Last time it was at 69.9. And a reading below 80 is typically when it's signaling that we could go into a recession. So we're improving, but since we're below that 80 level, there's a little bit of a concern there. And then the average 12-month inflation expectations fell to 5.8%, where they had been at 5.9%. So they're showing some gradual improvement, at least over the shorter term, not so much if you look at it in the bigger picture. JOLTS job openings weaker than expected, 7.437 million. Last time it was 7.712. FHFA housing price index up zero point 0.2. They thought it was going to decline 0.2. Last time it was down 0.3. Case-Shiller home price index up 2.8%, less than the 3% they had expected. Last time it was up 3.4%. And then these are just numbers I'm going to read off. I don't have charts for these. The advanced goods trade deficit, it was less than the 96.4 that we saw last time. It came in at 85.9, so that's showing less of a deficit. Advanced retail inventories came in as the same as the last reading, up 0.3%. And the wholesale inventories, they rose 0.3%, where last time they were down 0.3%. Okay, here are the charts, the FHFA Housing Price Index, where it's still very high, but going back where we topped out at the beginning of 2025, and now it is starting to come down here. And if this continues, that might actually help the housing market. It doesn't help the sellers so much, but if people can't buy the house anyway because it's so expensive and interest rates are higher, that really doesn't do much good there. And then the Case-Shiller Composite Home Price Index, this has it actually going up. And then on a year-over-year basis, it actually shows it dropping off. So it's still high, still rising, but not as much as what we were seeing before. And then the job openings, where it really spiked up in the previous reading, and the market was kind of freaking out over that, thinking that there was a lot of economic strength coming back into the market, but we dropped back down closer to what the readings that we've been seeing lately have been. And here's the consumer confidence, where we're going down as far as how people are feeling right now. There's a lot of crazy stuff going on, and it's hard to have some confidence in things. But we did tick up a little bit with the total reading, which is in blue, and then looking out into the future, the gold line there. So then we get this every week. This is the overbought, oversold composite. This is a day or so old, but we're at really high. We're above 90. Now, again, we could go higher than where we're at right now, but this is showing in a bigger picture kind of way that, yeah, we're overbought. That's usually when we see folks wanting to come in and take profits. And then the commodity traders advisors exposure to equities, that's going up too, not as high as it had been before, but a lot of folks have been getting into stocks as they've been experiencing FOMO, the fear of missing out or being left behind with all these returns that we've been seeing. And then positioning is now in line with S&P 500 growth, earnings growth, and second quarter suggests room to go higher. Okay. So, and this is Deutsche Bank that comes out with this, where they're projecting things up, the consensus. And then when I showed this last time, we were actually seeing a bit of a decline. This is the consensus here. And then they have this blended growth type of a thing. And for the most part, these lines are going up, and that tends to be more positive. Earnings sentiment. Also, how are people feeling about earnings? The dark line here at the very top, that's the US. That's the S&P 500, where we're getting a mixed picture when we look at some of the different global indexes. And we've known this for a long time now. We've been overvalued for years at this point, so I'm not quite sure what this chart is telling us that we don't already know. It's put out by Bloomberg, but it's like leaves little room for error. Okay, we've been seeing little room for error for 2, 3, 4 years now, where we've been quite overextended on a valuation basis. And there's been errors along the way over the last few years, but the market will go down and then it tends to go back up. So I'm not quite sure what they're getting at with this chart. Then Oppenheimer, they see 11% further upside potential. Now, this is also a Bloomberg chart put out by Oppenheimer. They think, yeah, we're going up. Now, that could be a little bit scary when you get folks who they think they really know. In fact, they're professionals and they're supposed to really know what's going on with the market, but yet they move en masse just like everybody else and tend to follow the crowd. And because we've been going up, they've actually bumped up their target here for what's going to happen. So you could look at that as, hey, yeah, they're looking pretty positive on things. You could use that in a contrarian view and say, well, we've been seeing a lot of the estimates for the S&P really getting revised up. Maybe that's when I should start to get a little bit nervous. Because again, even though they're professionals, they still tend to follow the crowd. All right, we expect higher tariffs to exert, okay, all this different stuff. Nobody really knows. And a lot of what's been happening, at least to this point, is the opposite of what people thought were going to happen because of all these trade deals and so forth. It seems like a lot of the tariffs are just being absorbed by the countries or the companies in those countries and not necessarily being passed on to folks in the US. Now, there's going to be exceptions to that, and it may change overall, but like in the EU trade deal, they're happy with 15%. Well, it still means that, okay, because we don't really know what kind of profits they were making by selling products to the US. And if they're happy with 15%, then that must mean that they can still make profits anyway. They have to be profitable. And so it's like you can project out things all you want, but a lot of the experts, they've been flat wrong about this. Okay, then fueling the rally has been a surge in net call volumes. This is a lot of the calls. This is why the VIX that's been okay, but the skew index, which is a variation of the VIX, that's why we were getting some pretty high readings there. But here we look at stocks that have been shorted. This is where folks think that either those stocks or those indexes are going to go down, and the most shorted stocks, they've been doing quite well, doing the opposite of what folks who shorted them thought was going to happen. And then Goldman Sachs top down versus consensus bottom up estimates. This just compares for the S&P, where we have the top down approach. Okay, we think they're going to grow 7%, but the bottom up, which uses more macro, actually top down uses more of a macro approach, where the bottom up uses, okay, let's look at the companies themselves. Actually looking a little bit healthier that way. And housing affordability. And this, the takeaway from this is really in what they say here. A 20% down payment on a single family home now represents a whopping 100% of annual household income. That's why a lot of people can't afford houses right now. Just to come up with the down payment, that's a year of income that's needed for that. And then labor market differential, Conference Board's labor market differential, the share of respondents who say jobs are plentiful, and then they subtract those who say they're hard to get. This is actually declining. That means that the hard to get jobs are starting to win out a little bit more. Then money markets, so versus the S&P, a lot is made of cash on the sidelines. And I try to point that out when we were talking about money markets. This is when interest rates were going up. People were taking their money out of the banks and putting them into money market funds. And a lot of people were saying, ooh, look at all this money on the sidelines. That can be put into the stock market and help it go up even more. That's not always the case. A lot of times they're putting it into a money market because they have a higher yield on that, and it's still very liquid. You can have checks and debit cards and everything attached to a money market. So why not put it there and get a much higher yield than what you were getting at your bank? However, as a share of total equity market value, it's significantly more subdued. So not a lot of this money, it just stays in the money market. It's not necessarily going to work in the stock market. Okay, then this has been kind of interesting. When we were really going down, we saw a lot of the gap downs. That happened in the overnight session, and that was producing a lot of the negative returns. As we've been coming back up, we're seeing the futures rather subdued, and we're seeing a lot of the strength actually coming during the market hours right here, and it's been outperforming lately. So we've seen more of a shift from what was going on before. You can see it here, how we were seeing a lot of the overnight trading was really accounting for a lot of the loss. Okay, then this is kind of convoluted. The takeaway here is corporate momentum. Corporate activities are firming up. This is supposed to be a positive chart here. The revenue per employee, that hit high. So it's like you hire somebody and they generate more revenue. That's good. The capital expenditures to sales is rising. Okay, that's good. We're spending capital to make money, and we're actually making money. And leverage is at its lowest. We're not having to borrow money. We're using actual cash to do this. Buybacks are up 16%. That's taken as positive. Dividends are up 6%. That's positive. And then mergers and acquisitions and initial public offerings, they're up 23%. Okay. These are signs of a positive market when you take all of this together. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. All right, here is the chart. Set the high right at the open, above R1, but that was it. We said bye-bye to that level right around 6,400. We drifted down here, fell below the unchanged level, below the daily pivot, below S1. Then we chopped them above and below S1 here, and then broke down here going into the close. We did bounce back up a little bit, but we did find some support down at S2. And not really active in the initial overnight session right now. You can see over here where the futures were positive, and we had that positive open, but then we spent the rest of the day coming down. Still looking okay here. We did decline with both the blue line and the red line, but the blue line is still above the red line, showing growth is outperforming on an intraday basis. We did take a bit of a hit with the S&P growth to value ratio, but we're still looking at the bigger picture here, going back to more the middle part of July where growth has been outperforming. We can go back to the beginning of July as well when we took that big hit right at the beginning of the month and take the bigger picture look here. So yeah, it's getting hit, getting knocked around a little bit, but the bigger picture is it's still remaining positive. So growth was down more, didn't have a really good day. Value was down, but down less. We were down less with growth for the mid caps and down less for the small caps. So it was more the bigger, large cap stocks where growth was hit more. So saw a little bit of a decline here. We've been chopping sideways as we've been doing for a while with the small cap growth to value ratio. A little bit of a tick down after breaking out with mid cap growth to value, and a little bit of a tick down after breaking out here with the S&P growth to value. This was looking more positive after Monday. We're seeing a bit of a pullback after Tuesday. And we were improving here with this growth to value ratio as well, but we ticked down in Tuesday's session. A little bit of a tick down, but bigger picture, we're still improving with discretionary to staples and looking at that ratio. This is what we're talking about with the trend. We got right up to that 40 level with the green line, and now it's starting to come down. Now we're still positive because the green line's above the red line. And we're getting close with the ADX in the short term. It's 39.7. When we get to 40 and above, that's when we think, okay, this is looking pretty exhausted. Now, we may not get to that 40 level, but if we go above it, we could still even go above that 40 level. Until we really turn down below the moving average, that's when we start to suggest that the trend is weakening instead of getting stronger, and seeing a bit of a rollover here with the intermediate term. Now, we're farther away from that 40 level, but the green line got kind of close, and now it's starting to come down, even though we're still positive with the green line above the red line. And we were above average with volume. You can see a little bit of a green with the histogram for the volume measure there. And we ticked up a little bit, but we're still well below 20 with the VIX, not only on a closing basis, but with the bar chart as well. This is what we're watching for. Typically, at some point in July, and as we work our way into August, this is quite often when the VIX tends to bottom out. That means stocks are going up. And then seasonally, we see the VIX going up, and that's can often be when stocks start to go down. We're wondering, is that beginning now? Or are we going to buck the trend? Last couple of years, this has been more prevalent. But, of course, anything can happen. We just want to be aware of what has historically happened to use that as a guide. And we did tick up here with the VIX of the VIX, but we're still below the moving averages, both with the bar chart and the line chart. But we came down with this fear gauge where we went up with this other fear gauge. So not any real confirmation there. We're continuing to decline with the equity put call ratio on the daily side. We really spiked up before the weekend, and then we dropped on Monday, continued to drop on Tuesday. But we're still going up with the 5-day chart, and we're going up with the 10-day chart. And that's more negative. That means there's still longer term hedging that's taking place. Still getting a very high reading, which could be interpreting some fear coming into the market when we look at the volatility risk premium. Advanced decline line still looking pretty solid here, even though there was a decline. We were flat based on price, but a decline here based on volume. And we did decline, but both the short and intermediate term advanced decline ratio are positive. We're actually going up here with the 10-day advanced decline oscillator. So that's still remaining more positive. Still looking pretty good here, but we're seeing a drop off in the new highs, a little bit of an expansion in the new lows. But the 5-day chart's going up. We're slightly going up, but flattening out with the 10-day chart. And rolling over a bit, but still above the moving average with accumulation distribution. But shorter term with the boom indicator, we're dropping down. This red line is considered to be an extreme reading, and we're actually falling below the moving average. So shorter term, this is looking more negative. Bigger picture, we're still positive. And we are negative with smart money indicator number 2. The Chaikin money flow is declining, and we're declining with smart money indicator number 3, the Chaikin oscillator. And positive but declining with the vortex. Then I wanted to show this. I bring this up periodically. This is longer term. This is a 50-period exponential moving average of the new highs, new lows for the S&P. And we're above zero, and we're continuing to go up. But this moves slower, so it'll take time to actually shift if we end up going more negative. But for the time being, we're continuing to be positive. Still looking okay here, even though we're coming down a bit with our advanced decline line studies across all the different indexes. And not much of a change here. We're still above 50 with the stocks in the S&P above their 20-period moving averages. As I've been trying to point out, we've been going up with the S&P, but we're setting a lower high here. That's a negative divergence with this indicator. You could also make a case for a negative divergence with the 50-period moving average study. And not really much of one, because we did set a bit of a higher high here with the 100-period moving average study and the 200. So it's more short to intermediate term where we're seeing more of a negative divergence. Okay, so here we go with the daily chart. We were down. We're still looking okay as far as the basic pattern overall, a series of higher highs and higher lows. Even though we had a down day, we set a new high. We didn't close at that high, but we set an intraday high there. We are in an uptrend, and we're back above the moving average with volume. And we ticked up just a little bit here with the 20 and 50, but we are flat after declining with the 200-period moving average on the S&P. The Stochk RSI, which had been on the list, it dropped down enough, so it's not on our extreme positive list now. We are declining, but the Williams percent R is still extreme positive, and the same thing is true with the CCI 14 and the CCI 20. Coming down below the moving average. This is the short-term stochastic. That's more negative, but we're still extreme. We're crossing below the moving average, but still extreme with the intermediate short-term, and we're still positive with the long short-term stochastic. And dropping below the midpoint with the force index, even though it's green, it's still above zero. And you can see here that these lines, these are Keltner bands here, and they're getting kind of close to each other. And that, it's like winding up a spring. The more you wind it up, the more the move is going to be. And we're not quite sure if that's going to break back to the upside, or if we're going to break to the downside, or how long this could actually last. Still looking okay here with the short-term trend based on 20 periods. Both the blue line and the green line are going up, but they're pretty much on top of each other. Coming down just at the low end of the +3 channel with the standard deviations chart. Another negative divergence here. We've been going up with the S&P, but the balance of power has been going down, even though it's still above zero. Coming down, but still above the black line, which is an extreme reading with the CMB composite. Still positive with the go, no go, since it has the darker blue bars. Still not too far from the highest high value here. That's positive. And this is more of a time measurement. We're positive since it's green, but now this has us as 61 days that we've been in an uptrend according to this Landry Light chart. Still positive here with the proper order. We're still seeing another sign of a negative divergence as we've been going up with the S&P. The TTM squeeze is actually declining and has turned negative and just kind of floating along. We're not seeing, this is usually a pretty touchy indicator, but going back to about the end of May, it's just been flatlining slightly above zero. This is the Arun here, where we have the green line at the top. The red line's been going down. That's where we're getting a pretty extreme reading with the oscillator itself. And we're still below zero with the S&P McClellan oscillator. That's looking a little more negative in the short to somewhat intermediate term. And then intermediate term to even a little bit long term, that's the summation index. We're going down based on price and volume. We're also still below zero with the NYSE McClellan oscillator. That's declining below zero. So we're starting to go down more here with the summation index based on price and volume for the NYSE. And going down now with the Swindler trading oscillator, declining based on price and volume. Just flatlining here above this red line. We're still extreme with the PMO. We're actually crossing a little bit below the moving average based on price, looking a little bit more negative below the moving average here based on volume. And we're still below 50 with the PMOs that are rising. And we're starting to come down. We're still a little bit above 50 with the buy signals. Still getting quite a high reading, though, with the PMOs inside the S&P that are above zero. And we've gone from positive over to the neutral with the Elder's Impulse system. Still positive with the parabolic SAR. Trying to improve here, but still below the moving average with the slope oscillator, but we're still above this green line, so we're looking extreme there. We were potentially turning positive with the MACD, but now it's coming right back down to its moving average. So our two short-term oscillators are actually not confirming each other. We're looking more negative with the slope, where we're still positive with the TSI, the True Strength Index. Then we look at three intermediate term indicators, and these are pretty much flatlined right now. And then we have two long-term oscillators, the TRIX and KST, also flatlining right at this green line, just below the extreme reading here with the KST. Copy curve is trying to improve, but it's still below the red line, so that's negative. And after being in the dark green area, the Sean trend meter is now starting to come back into the lighter green area compared to the dark green area. Did decline, but still above 50 with the money flow. Also still above 50, but declined with the ultimate oscillator. Tick down here, but we're still positive with on-balance volume. Rolling over here, but we have not generated an official overbought condition yet with the RSI 14 or the RSI 9. Still looking good here. Even with the pullback, we're still above this 10-period simple moving average line here. That's what we'll be watching first. If we end up closing down below that, if there's more declines that come, then we'll be watching the orange line, and then we'll be watching the blue line after that. But so far, this is still remaining positive. And we're still below the red line, but the red line and the blue line are going up when we look at the condition of the intermediate term trend based on 50 periods. Still above the 20-period moving averages here, and all of the moving averages are going up. That's still positive. We're not really far away now, or at least too far away with the boom indicator from the 20 period. We're still far away from the 50-period moving average. And we're declining below the moving average and no longer extreme positive with the bullish percent index for the S&P. We're declining here with the NYSE bullish percent index, and we actually went up with the NASDAQ 100 bullish percent index, and it's now extreme positive. And we're keeping an eye on this longer level. I've been trying to bring this up here just to give you a reference point. We have an R1 level at 64.68. Now, we haven't got there yet, but if we do try to make a bounce back up here, is this longer term resistance level going to cause a problem? But we're still positive with the trend. We're still positive here with the Heiken Ashi, the Kagi chart, the Renko chart, and the three-line break. Our trend has not switched over to positive or negative, at least yet. And we're still far away from the 150-period simple moving average, even though we declined. And we're still quite positive, but declining here with the 200-period moving average steady. Positive on all time frames with all the different indexes. And bonds are showing some improvement. We're positive in the short and intermediate term, still negative in the long term. Commodities are back to being positive on all time frames, and the dollar is actually in a short-term uptrend now. And we saw kind of a mix here with real estate, utilities, energy, staples. These are the areas that are considered to be more defensive. Tech was virtually unchanged. And then we saw discretionary and communication, not down huge, but they did underperform. And so we started off the day good. We got above 6,400 with the S&P. Canada is still setting new all-time high, as is the S&P earlier on. And then NASDAQ and NASDAQ 100 on an intraday basis did set an all-time high, but then we saw it come down and drop below that 21.1 level. We had a bearish MACD crossover with staples. Now that could be positive because staples are more defensive. And if they're underperforming, that is usually more positive for the market. And then here's where the BPI cross was below 70 that I showed just a moment ago. More red, but not big red here. The Apple was down more than 1%. Microsoft virtually unchanged. Nvidia down slightly with the tech stocks. Discretionary, both Amazon and Tesla declined. We saw a mix with communication where Google was up, Meta was down. So just back underneath this pivot point here with the Dow, but we still are in an uptrend. We had a recent golden cross there, and we continue to be neutral with the diamonds with the Elder's Impulse system. We came up close to this pivot point here, and that's a little bit lower than that is where we set the high for the NASDAQ in Tuesday's session. And we've gone from positive to neutral with the Elder's Impulse system for the NASDAQ. Also, we still have a ways to go to get up to this R1 level, but this is still a pretty good looking pattern overall with higher highs and higher lows for the most part. And we've gone from positive to neutral with the Qs when looking at the Elder's Impulse system. We're still drifting off here with the PPO. This is a momentum oscillator for the NASDAQ 100. It's been going up as this oscillator has been going down. Still dealing with this long-term trend line with the NASDAQ 100 weekly chart. We're still just a little bit above it. Still above the 200-day moving average with the small cap S&P 600. And we're getting really close to a golden cross here with the Russell 2000 small cap index. As long as we continue to be above both moving averages, that should generate a golden cross. But we switched over to negative with the small caps with the Elder's Impulse system. We're starting to generate a golden cross here with the mid caps. So the small caps are still the last holdout. Even the micro caps generated a golden cross recently. But we're neutral with the mid caps looking at the Elder's Impulse system. Did come down here, but still looking pretty good with the Wilshire 5000 broad market measure. The same is true with the total U.S. stock ETF. Financial sector was down 0.5%, but still looking solid by itself. It's just continuing to underperform the S&P. We're still below the 200-day moving average with the ratio. The FANG index, it was down after setting an all-time closing high after Monday. So Apple was down 1.33%. We had Amazon, it dropped down 0.75%, but still in an uptrend. Google, recent golden cross here, it was up 1.65%. Microsoft virtually unchanged in an uptrend here. Meta coming back down close to its 50-day moving average. Nvidia declined, but it's still in an uptrend. Tesla just kind of bouncing around. It was down 1.35%. Netflix continues to decline below its 50-day moving average. It's like now the stock can't seem to get a break after it had been one of the strongest stocks of the Magnificent Seven, at least the Magnificent Seven that I look at. But semiconductors. Now, the other semiconductor index that we follow, that went down. The Dow Jones Semiconductor Index, we're actually showing this increasing by about 0.5% here with the SMH Semiconductor ETF. So a bit of a mixed picture there. A little bit of a drop-off with the short-term correlation between U.S. and world stocks, leveling out after it had been declining with the longer-term correlation. Oil was up, and a lot of this has to do possibly with, problems with Russia, what's going to be happening there. So oil prices are jumping up. And the dollar still above its 50-day moving average. Now, it's got a lot of damage to repair here, but this is the first time going back to about February that the dollar has actually been above its 50-day moving average. And the latest reading from Trueflation has us a little bit over 2%. We're still below that 4.5% level with the 10-year yield, and we did see a drop with the 10-year yield. So when that drops, the price of the 10-year yield is going up again here. Still looking okay with the Q to S&P ratio. We're above the moving average. We're just kind of chopping around at the moving average with discretionary to the S&P. Still looking good here when we compare large cap growth to value. So we're above the moving average with the large caps, mid caps, dropping below the moving average with the small caps. And we're back to being inverted again here. We're at minus 0.01 with the 10-year to 3-month yield curve. The 10-year to the 2-year, that looks fine, and that's what most people follow. But I also follow this one, and it's been chopping up and down, going inverted, uninverted, back to inverted now. And when that happens, and then we stop being inverted, and then it starts to actually stay in one direction, that's typically when we keep a closer eye on, are we actually going to go into a recession? With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Okay, so the outlook for Wednesday, throughout the week, about 38% of S&P 500 companies are reporting earnings. We're still positive on all time frames, and we're still trending for the time being. We're going to get the MBA Mortgage Applications Index. We get that every Wednesday. The ADP employment change, so some more employment data will be coming out. The first look at GDP for the second quarter. That could be kind of interesting. Pending home sales are going to come out, and then the Fed's going to make their decision at 2 p.m. Again, it's not so much what they're going to do, it's what are they going to say after the meeting. And then anything geopolitical, which can include not only the wars going on between Russia, Ukraine, Israel, and Iran, but any trade deals or tariffs that may be announced there. Here is a look at what will be coming out on Thursday, the initial jobless claims, the PCE prices. That includes the core PCI, another major inflation report that will be coming out. And then we have the big employment report coming out on Friday, in addition to ISM manufacturing and consumer sentiment. So here's a look at what will be happening in Wednesday's session here. Seasonality, kind of strange. For July 30th, we're neutral to negative with the Dow, but we're flat out positive with the NASDAQ and the S&P 500 going back to 2002. And we're coming into that time where during a post-election year, sometimes we see a pop for the last couple of days, but who knows if that's what's really going to happen. But historically, this is what has happened for the July 30th session and then the last day, which will be July 31st. And we're finally finishing up the second half of July here. Also, the Carson chart shows a little bit of a bump as we further close out July. This is new here. It says a potential worry for 2025. It says the S&P performance in August, the second term of post-election years. Now, this is strange because Trump was president, then he was not president, now he's president. So that's his second term. And so, yeah, it's a post-election, but it was broken up. Grover Cleveland was the only other president where that happened, and we don't really have statistics for that one. But not really good in August. The average return in the second term was minus 3.4%. The median is also 3.4%, and we've never been positive, according to this, going back to 1950. So that's why I've been trying to gear up and say, okay, seasonally, August, at least from a historical perspective, could end up looking kind of negative. But who knows? We could always buck the trend. We've got a perfect track record to the negative side here, but usually we don't see statistics like that. Usually there's times when it's not 100% or 0%. Usually it's somewhere in between. All right, so our three smart money indicators. Now, bigger picture, accumulation distribution is positive, but we're declining with the boom indicator, so that would be negative. Where the other two indicators, the chicken money flow and oscillator, they are negative. And we're now negative with both the S&P and NYSE McClellan oscillators and summation indexes, the swell trading oscillator. The bullish percent index declining. It's no longer extreme positive, but it's below its moving average. And our oscillators just flatlining, seeing a little bit of a divergence between the two short-term oscillators, but the Copic curve is still negative as well. And the momentum for the NASDAQ 100 continues to be negative, and the long-term special K chart is negative. And I'm not showing it in this unless there's a change, but the Zohorchak method, that's a very long-term chart. It's still on a sell signal. Positive signs, though, the growth to value and discretionary to staples ratios are holding up. Parabolic SAR is positive, as is the NASDAQ 100 bullish percent index, and that actually went up and is extreme, where we're declining here, but still above 50 with the NYSE bullish percent index. And then the ease of movement, money flow, ultimate oscillator, the vortex, all these are still positive, the financial sector as well. Here are the pivot points, and we had kind of a wide spread between the open, high, low, and close for Tuesday. So we've got a pretty wide range here for the R1, R2, S1, S2 levels. So the conclusion hasn't changed though. As long as we're above the 20-period moving average, we're still positive in the short term. We're seeing some weakness coming in, but we're still trending. But for right now, it's just looking more like a pullback. Now, we'll keep evaluating that day after day, and if it does start to switch over and look more negative, then we will adjust things accordingly. Thank you. Have a really good day, and I will talk to you in the next video.